You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Okay, so last week we looked at a diagonal spread, which we hadn't talked about very much in FedEx. And I have a couple of trades that I need to look at based off of what our forecast was, what our plan was, and what actually happened. FedEx, unfortunately, when we do a paper trade, it's a lot of times better if it does go against us, because then we can talk about what we'd like to do to repair that trade. And FedEx, as far as the trade is concerned, it didn't really hurt us the way that the underlying stock moved, but it definitely went in an adverse direction as to what we would like to have seen based on just the strike prices we chose and the expirations that we were looking at. So we're going to look at FedEx. We're going to talk about the trade last week, because I really think if you want to go back and just look at how a trade played out, this was a great learning experience on diagonals. Even the reason why we set up the trade with multi-months, which is a diagonal. And then we're going to actually stay in FedEx because we have earnings coming. And FedEx is a $262 stock, and it's always fun to trade earnings on higher price stocks. So if you want to follow along at home, eventually we're going to get there. We're going to start by looking at the trade of the day, or the strategy of the day was going to be a long call butterfly, and that's on page 102. The trade from last week was a diagonal spread with calls, and that is actually on page 96. So if you have the playbook on your table and you want to follow along at home, you feel free. If you do not have a playbook, no worries. Just go to optionsplaybook.com. The entire book is there at your fingertips, just at www.optionsplaybook.com. And let's get going here. So we're going to recap what happened in FedEx. It wasn't necessarily a bad thing. There could have been a better scenario that would have happened, but when we put on the trade, we knew that FedEx was going to announce earnings on the 19th of June. Oh, and I should emphasize here that we are taping this on the 13th of June, and the markets are closed. So last week, we were a couple weeks away before the earnings, which is on the 19th. And it's after the close. So we were we were hoping what would happen is that the implied volatility on the option we were buying after the earnings report would continue to creep up. And the shorter term implied volatility, even though it was lower at the time we put the trade on, would just basically kind of go away, whittle away, and that would expire worthless. And then we could decide what we wanted to do with the long call. We mentioned in the call that if at any point in the expiration process, the short option, the nearest term option that we sold, if it hits that short strike, we want to do something with it. And one thing that we could do is just get out of the trade. Another thing that we could do in that scenario is roll the underlying position. And if I go back and I look at the charts here in FedEx, and I'm only going to focus on those days, okay? So we taped Options Playbook Radio on June 6th after the close. We sold the 2750 strike call, and we bought the 2760 strike call. The expiration for the short one was very short. It was June 8th, and the expiration for the long one was June 22nd. And part of the reason why we did such the short one is that we got a lot of juice for it. The midpoint on the short option was $1.15, and that gave us a chance to roll to the next week out because it does have weeklies. So there was one more expiration from the 8th to the 15th to the 22nd. So we had a chance to roll, and that was a big reason why we did this. On that day, the stock was up $4.50 some odd cents, and it was trading underneath our 257 level, our short strike, at 256.55. Okay, so on Thursday, we have 2 full days of trading. On Thursday, it was kind of an uneventful day. If you looked at the chart, it was a doji star that the chart printed for that trading day, meaning the stock hit some highs and hit some lows, but mainly traded right in the middle of the range most of the day. And it did open at 257.30, which is our short strike. So it ended up closing basically at the exact same spot that it opened at. But because it opened at our short strike, we should have instantly rolled the underlying. And that's why I find this trade interesting overall, in that the stock moved, and we said if it hits that short strike, we should have, if we would have got out right on the open, if you would have been around your computer and got out right on the open, you should have had a small profit or zero profit. So in other words, an option would have been to just close out the trade if you wanted to. That would have totally been an option, would have been a very minimal loss. We paid $321 for the entire diagonal spread. That was the net debit to the account. We should have been able to get out close to that based off of that type of movement. Now, the next day, it definitely opened up higher. So we would have wanted to be out of that trade for sure. On the Thursday before the expiration, on Friday, the day of the expiration, I should say, because there were only 2 trading days, the stock opened down a little bit at 256.97. That would have been another opportunity to roll or close out that position. But it closed near its highs for the day. It closed at 260.15. So I would have wanted to get out of that trade at that point in time for sure, not getting into the long call side. And that position, you would have been already out of your trade. So here's the trades that I would have done trying to manage this position. If the stock opened up a point on the very next day and it hit my short strike, at that moment, I probably would not have just closed my position. Because we set up the trade with the expiration in between, the June 15th expiration, what I would have done is bought to close the June 8th contract, all right? And I would have had to pay up a little bit for that. I would have had a small loss on it. And then I would have sold to open the June 15th expiration, okay? The one in between are 2 expirations that we started with, the June 15th expiration, and I would have sold the same strike that I was long, turning this into a time spread. So we started with a diagonal spread. It hit our short strike. We roll into a time spread going into that earnings report. And lo and behold, the very next day, on that following Monday, I would have been out of that trade totally, because the underlying stock on Monday opened up at our strikes again, the 260 level. I would have not let it continue the trade, and I would have closed out saying, I don't want the cheese anymore. I already adjusted this trade. Just let me out of the trap. That would have been my whole process in putting the trade on. Now, if you stayed in it, right now the stock is at 262.92. That's where it closed at today. And you'd be okay. You'd be profitable on that position, mainly because the implied volatility on the June 22nd option contract has spiked up quite a bit. And that's exactly what was protecting us here. So on that instance, we had implied volatility when we started this scenario. We had a difference in implied volatility. It was basically flat. There was really not a lot of difference in implied volatility. And right now we have the June 15th expiration, the one we would have rolled to, at 17%, and the June 22nd expiration implied volatility at 31%. So there's quite a bit of difference in skew between those two underlyings, and that's the whole reason why we put this trade together. FedEx didn't cooperate. It moved too fast for us. We really just needed to get a couple of days without it reaching our short strike, but it did. It moved real fast on us. And I think, once again, this is a great learning scenario in that the trade went against us, but we had a plan and we stuck to our plan, and we would have got out of the plan at just a minimal loss to us because we set up the trade correctly. So I'm going to recap one last time. If you want a pen, put it together. So here we go. Here's the initial trade that we put together on the 6th of June. We sold the June 8th expiration 2750 call. We bought the June 22nd expiration 260 call. The stock was at 256.55. We did it for a net debit of $3.20 to the account. Up to that first expiration, that would have been our maximum risk on this trade. So that's what we put on. The underlying stock moved against us right away. It hit our short strike. We would have then bought to close the June 8th 2750 call, removing our diagonal, and sold to open the June 15th 2060 call, the same strike as our long strike in our diagonal, hence rolling this into a calendar spread. So we buy to close the 2750, sell to open the 260 on the June 15th expiration, and now we have a long calendar spread. The stock then rockets up to our short strike, and we close everything out and say, okay, I don't want any more. No mas, no mas. I'm out of this trade. Okay. So we had a loser. So let's get our money back on it, right? So we lost on the trade. And FedEx, the chart has really been kind of outrageous going into earnings. It's almost like they announced earnings a while back. So since there are not many red candles from the 5th all the way up until today, which is the 13th of June, and the market is closed. So we've had a pretty big run up. On the 5th, the day that the green candles kind of set in, the stock was at 251, and it's ran up 12 points to almost 263 at this point in time. So since we've had a fairly decent run up over that short time period, let's look at doing an at the money butterfly. Let's just see if the stock is whimpered out and they're going to announce earnings, and we're saying to ourselves, we do not think the market will move as much as expected. Okay, so we're going to stay in our FedEx trade, and we're going to do an earnings trade. We now know earnings is right around the corner. We're talking about the 19th, And today, once again, we have it on the 13th. So we're just going to look at doing a butterfly. And first of all, we're going to need to know, well, what is this expected move based off of the implied volatility on this underlying right now? And the expected move, and we might do this a little closer to the date, but we're stuck in the day right now on the 13th of June. So let's just look at a butterfly. Let's look at how it all plays out. So we're going to do whatever the width or the expected move is. If I look at that June 22nd expiration, I see that the expected move, if I buy the at-the-money put and buy the at-the-money call, which right now the stock is at 262.92. We're talking about $11 implied, $11 move, $11.50 to be more accurate if we look at the midpoints. $11.50 is about the expected move for that earnings event, for that big event, before the June 22nd expiration. Okay, so we're going to go 10 points wide. We're going to say that this stock is not going to move 10 points going into earnings, going after earnings. The expected move is 10 points. We're hoping that the stock just settles down. So the trade that we have, we're going to do the June 22nd expiration. And we're going to look at buying the 252.50 call, selling 2 of the 262.50 calls, and buying 1 of the 272.50 calls. So 1 by 2 by 1 butterfly, 10 points wide, and is currently trading for $3.40. That is our max risk on this trade, is $3.40. We hope the stock stays within the 2 strike prices. Ideally, we would like it to stay within the break-even points, that it would never move outside of that range. And in order to get to the break-even points, though, we need to add to the long or the most in-the-money option contract, I guess is the best way to say that. The 252.50 strike, we're going to add what we paid for this, which is $3.40. So our break even on the downside at expiration is $255.90. And on the upside, we want to take the most out of the money strike, which is the 272.50, and subtract out our debit that we paid, which is $3.40. And that would mean that on the upside, our break even point is $269.10. We'll pay a lot of attention to that. If it gets to that spot, if it gets in that range before earnings and it doesn't just settle down here, well, then we just want to get out of the trade. So I'm not looking at a price to get out of the trade. I'm saying that if it gets anywhere near our break evens, we're going to think about it. And if it hits any of our protective strikes, our long wings, we're just out of the trade if that happens before the actual earnings announcement. After the announcement, this is a volatile trade. And if the stock really moves, implied volatility is going to come down, and that could hurt us. And we would just get out of the trade on the open if the stock moved more than the expected move in that situation. So that's it for this episode of Options Playbook Radio. We basically managed a diagonal trade in a fairly pricey underlying, which gave us a lot of room to manage. There was a lot of time premium in these option contracts. And now we're going to go back and try to stick with this underlying now that we've had this big move in one direction over the last about 10 days. We're going to look at just doing a more neutral trade. We're just going to do a flat out long butterfly call centered around where the current stock price is at. So that is it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.